When it comes to trading, there's probably no topic that gets people more fired up than technical analysis. I mean, is it a legit way to read the markets? Or is it just drawing random lines on a chart? Well, today we're going to cut through all that noise. We're going straight to the pros, the hedge fund managers, to find out what they really think. Let's see if the so-called smart money is even playing the same game. You know the scene. Hop into any trading forum online, and it's a war zone. You've got one camp that treats chart patterns and trend lines like they're the gospel truth. It's their absolute Bible. And then you've got the other camp, the ones who say it's all just financial astrology, a total joke with zero predictive power. So who's actually right? Instead of getting bogged down in some endless Reddit argument, we figured, hey, why not go straight to the source? We went out and found interviews with people who've managed billions, with a B, of dollars, people who've spent decades in the trenches of the market. We're not interested in what some teenager on a forum thinks. We want to hear from the people with real, high-stakes experience. So here's how we're going to break this all down. First, we'll look at the great debate itself. Then we'll tackle whether TA is more of an art or a science. After that, we dive into the really juicy stuff, hunting for liquidity. Then we'll explore the paradox of stop losses, and finally, we'll get to the professional verdict. Okay, so let's get right into it. To really get what the big institutions are thinking, we first need to know who we're actually listening to. For this, we put together a pretty killer panel of pros, and they all bring something different to the table. We've got Corvin Koderla, an ex-hedge fund manager from JP Morgan, who built purely data-driven strategies. Then there's David Paul, a managing director who has that big picture strategic view. We'll also hear from Mark, an algorithmic trader who literally lives and breathes the code that executes these massive trades. And finally, Andre, a senior portfolio manager. He's the guy who has to make the final call. So together, we should get a really solid picture. All right, so first up is Corvin Koderla, and he gets right to the point with a really critical distinction. We need to be crystal clear on what we even mean when we say technical analysis. So here's Corvin's whole philosophy. For the kind of systematic fund he worked for, technical analysis is only useful if it's 100% testable. That means the rules have to be totally objective, completely black and white. There's no room for feelings or saying, oh, I think the momentum feels a bit weak. The rules have to be so concrete that, as he puts it, someone in Mongolia who doesn't even speak your language could follow them and get the exact same trade every single time. But, and this is the part I love, he's also a pragmatist. He knows a ton of traders use a more subjective, kind of artistic approach. And while his fund can't test that stuff, his attitude is basically, hey, if it's making you money, who am I to argue? At the end of the day, that's really all that matters in this business, right? Profit is profit. Okay, let's switch gears to probably one of the most controversial topics out there, stop hunting. Is it a real thing? Are the big banks and hedge funds really out there trying to trigger your stop loss on purpose? Well, David Paul, a managing director, is going to give us the inside scoop. To really get this, you have to understand that retail traders and institutional traders are playing two completely different sports on the same field. You, the retail trader, might wait for a perfect confirmation candle before you jump in, and then you place your stop loss in a really obvious spot, like right under the last low. But the big institutions? They don't wait for confirmation. They've already decided what a good price is, and they place their enormous buy orders right where they know all those retail stops are waiting. Now, this is the key thing to get your head around. It is not a personal attack. The fund isn't sitting there in a boardroom saying, let's go get Bob's $500 stop loss. No, they're thinking, we need to buy $200 million of this thing, and there just aren't enough sellers right now. They have to go where the orders are, where the volume is. They're hunting for liquidity, not for you. And here's exactly how it works. Step 1, all the retail traders put their stops in the same obvious spot. Step 2, the institution needs to buy a ton. But there isn't enough volume, so what do? They place their huge buy orders right at that same level. Those huge bids act like a magnet, pulling the price down just enough to trigger that big cluster of retail stops. And what happens when a stop loss is triggered? It becomes a market sell order, providing the exact liquidity the institution needed to fill their giant buy order. It's just a mechanic of the market. I mean, just let this quote from David Paul sink in for a second. This is an absolute game changer. It flips everything you've probably been taught completely upside down. He's not saying to put your stop there. He's saying that's where he wants to put his entry. He's telling you to think like the institution, not like the rest of the crowd. So this leads us perfectly into our next section, because if institutions are basically targeting these clusters of stop losses, how in the world is a professional supposed to use them? And it turns out even the pros are fiercely divided on this one. First, let's just touch on the advice you hear everywhere, right? If a trade feels risky, the common wisdom is to slap a really tight stop loss on it to keep your potential losses tiny. Sounds logical. Manage your risk, cut your losers short. Makes sense. Well, not so fast. According to Andre, a senior portfolio manager, that's not just wrong, it's deadly. He makes this absolutely wild claim that tight stop losses are the #1 reason most traders fail. I mean, that's a huge statement that goes against everything we're taught. So what is he talking about? So here's his logic. Markets almost never move in a straight line, right? A trade often goes against you a little bit before it goes your way. Well, the market makers know exactly where everyone has placed those nice, tight, predictable stops. And it's super easy for them to just push the price down to that level, shake everyone out, and then let the price run in the direction you thought it would go. So you were right, but you still lost money. His solution? If you're confident in your idea, you have to give the trade room to breathe. Okay, time for our final section. Let's try and tie all this together. We've heard some conflicting ideas, so what's the actual verdict? Well, our algorithmic trader, Mark, adds the final, crucial piece to this puzzle. It really depends on the size of the fund. This makes it so clear. Think about it this way. A mega fund managing billions is like an aircraft carrier. It moves slowly, it plans its course way in advance based on huge fundamental trends, and it can't just turn on a dime. It doesn't really care about some tiny support or resistance level. But a smaller $100 million fund, that's more like a speedboat. It's nimble, it can use those technical levels to pick the absolute perfect moment to jump in or out of a trade. So after hearing from everyone, the verdict is, it's complicated. No, hedge funds are not sitting there all day staring at head and shoulders patterns like a retail trader might be. Their big decisions are driven by much bigger things. But it would be totally wrong to say they ignore technical analysis completely. This is how they actually use it. 1, it's used systematically, but only if it can be proven with hard data and objective rules. 2, they use it to understand the market structure, to see where the crowd is positioned. 3, they use it to find those pockets of liquidity we talked about. And 4, the smaller, more nimble funds use it to really nail their entry and exit timing. It's a tool in the toolbox, not the whole toolbox itself. And honestly, if you take away just one thing from all of this, let it be this. For a professional, a chart is not a crystal ball. It doesn't predict the future. It's a map. It's a map of human behavior, of fear and greed. It shows them where other traders are likely to feel pain, and most importantly, it shows them where the money is. They're analyzing the other players at the table, not just the cards. So I'll leave you with this final question to chew on. Now that you've gotten a peek inside how these massive institutions think about the market, are your own strategies designed to trade with them, or are you just setting yourself up to become their liquidity?